you mentioned Jell-O or Velveeta. Charlie works at my grandfather's grocery store in 1940. I worked there in 41. And if they were buying those products then, they buy the products now. The margins are still very good. They earn terrific returns on invested capital. But we paid too much in the case of Kraft. You can pay too much for a growing brand. I mean, you can pay way too much for a growing brand. Probably easier to be sucked into that. So I basically don't worry about the brands. Certain of them are very strong, and certain of them are declining a bit. But that was the case 10 years ago. It'll be the case 10 years from now. It's not. There's nothing dramatic happening in that. Okay, we'll take one more and then we'll break for lunch. Andrew.
Thank you, Warren. Question on technology and the company's biggest holding now. Given that Apple is now our largest holding, tell us more about your thinking. What do you think about the regulatory challenges the company faces, for example? Spotify has filed a complaint against Apple in Europe on antitrust grounds. Elizabeth Warren has proposed ending Apple's control over the App Store, which would impact the company's strategy to increase its services businesses. Are these criticisms fair?
Well, again, we're not. I will tell you that all of the points you've made, I'm aware of, and I like our Apple holdings very much. I mean, it is our largest holdings. And actually, what hurts in the case of Apple is that the stock has gone up. And we'd much rather have the stock. And I'm not proposing anything be done about it, but we'd much rather have the stock at a lower price so we could buy more stock. And importantly, if Apple, I think they authorized another $75 billion the other day, but let's say they're going to spend $100 billion in buying in their stock in the next 3 years. You know, it's very simple. If they buy it at 200, they're going to get 500 million shares. They've got 4,600 million out now, and so they'll end up with 4.1 billion under that circumstance. If they're buying it at 150, they'd buy in 667 million shares. And instead of owning what we would own the first case, the divisor would be less than 4 billion and we'd own a greater percentage of it. So in effect, a major portion of earnings, at least possibly, it's at least been authorized, will be spent in terms of increasing our ownership without us paying out a dime, which I love for a business, a wonderful business. And the recent development, when the stock has moved up substantially, actually hurts Berkshire over time. We'll still do, in my opinion, we'll do fine, but we're not going to get into, we're not going to dissect our expectations about Apple, you know, for people who may be buying it against us tomorrow or something. So we don't give away investment advice on that for nothing. But we have all the things you've mentioned. Obviously, we know about. We know some. We've got a whole bunch of other variables that we crank into it, and we like the fact that it's our largest holding. Charlie?
Well, in my family, the people who have Apple phones, it's the last thing they'll give up.
Not a bad item to have. And the other thing we won't give up is lunch. And we'll now adjourn and we'll reconvene at 1 o'clock or thereabouts. I'll see you a little later. Okay, if you'll take your seats, we'll proceed in a minute. And it looks like we're ready for Greg.
Warren and Charlie, I have a follow-up on the railroad business. By nearly all measures, BNSF had a solid year in 2018. Full-year revenue growth of 11.5% was better than the 7.5% top-line growth the Union Pacific, which is BNSF's largest direct competitor, came up with Burlington Northern seeing both larger increases in average revenue per car unit and total volumes than its closest peer. Even so, Burlington Northern once again fell short of Union Pacific when it came to profitability, with its operating ratio declining 130 basis points to 66.9%, while Union Pacific's ratio fell only 120 basis points to 62.7%, further cementing the spread that exists between the two companies' margins at more than 400 basis points. Can you explain what is driving the difference in profitability between Burlington Northern and Union Pacific, as theoretically we should not see that wide of a spread between two similar-sized companies that are basically competing for the same business with the same customers in the western half of the United States? And while you noted that Burlington Northern is in a wait-and-see mode with regards to precision scheduled railroading, we've kind of heard the same line historically with regards to Geico's approach to telematics. And what worries me here is that the potential now exists for a much wider gap to emerge between profitability levels at Burlington Northern and Union Pacific, which has recently adopted a version of PSR, some of which Union Pacific could eventually use to get more price competitive.
Well, Warren knows the answer to that a lot better than I do. My guess is that they work a little harder than we do at building the rates. But Warren, you answer that.
Yeah, well, it's true that we receive the lowest ton-mile revenue of any of the 6 big railroads in North America, and there's some explanation for that, obviously, a significant explanation in the particular types of hauls we have and that sort of thing. We do have longer hauls generally. But the answer, Union Pacific's profit margin, they talk about operating ratios, but that goes back to the Interstate Commerce Commission. It's really profit margin, pre-tax, pre-interest profit margin. And the Union Pacific, at one time, probably 15 or maybe a little more years ago, they really went off the track, so to speak. But they've done a very good job of getting, well, they got a lot of underpriced coal contracts worked out, as did we. But they've also they've done a very good job on expenses, and there's no fundamental reason why the BNSF franchise. I always like the Western railroads better than the Eastern, not by a dramatic margin, but I think the West will do better in terms of ton miles over time than the Eastern roads. And we've got some great routes, some of which were underwater in March for a while. And we pay a lot of attention to what's going on at the Union Pacific, as we should, and the future. It's not like we're losing business to anybody, but they have been operating more efficiently, in effect, than we have during the last few years. And like I say, we take notice of it. They've cut a lot of people. I mean, right here at Omaha, and we'll see what that does in terms of passengers or in terms of shipper satisfaction. But we are measuring ourselves very carefully against what they do, and if changes are needed, we'll do them. We've got a wonderful asset in that business, and when I bought it, I said it's for 100 years. It's for a lot more than 100 years. It is a very, very fundamental business, and we've got a wonderful franchise, and we should have margins comparable to other railroads.
Charlie?
I don't know much about it.
Yeah.
Station 9.
Hi, Warren and Charlie. My name is Rob Lee from Vancouver, Canada. Could you please share with us what do you value the most in life now? Thank you.
Well,
Well,
you'd
I
have-
like to have a little more of it.
It's the two things you can't buy, time and love. And that I value those for a long time. And I've been very, very, very lucky in life in being able to control my own time to extreme degree. Charlie's always valued that too.